Demystifying investment jargon for beginners, your path to financial freedom. Tired of feeling lost in the world of investing? Does the jargon make your head spin? Don't worry, you are not alone. This video will break down the essential terms and concepts, empowering you to start your investment journey with confidence. Investing is crucial for building long-term financial security. It's not just for the wealthy, it's for anyone who wants to secure their future. Think of it as planting a seed today to harvest a bountiful crop later. Investing allows your money to grow over time, potentially outpacing inflation. This helps you achieve your financial goals, like retirement, buying a home, or funding your children's education. It's about making your money work for you, not the other way around. At its core, investing is simply allocating money with the expectation of future income or profit. You are essentially putting your money to work, hoping it will generate more money. This can take many forms, from buying stocks to investing in real estate. The key is to understand the risks and potential rewards associated with each investment. It's about making informed decisions based on your financial goals and risk tolerance. Remember, every investment carries some level of risk. Let's be honest, the world of investing can seem incredibly daunting, especially when you are bombarded with unfamiliar jargon. Terms like derivatives, options, and short selling can feel overwhelming. But don't let the jargon scare you away. This video is designed to cut through the noise and demystify the essential investment terms you need to know. We'll break down complex concepts into simple, easy-to-understand language. By the end, you'll feel much more confident navigating the investment landscape. Let's start with the basics: stocks. A stock represents ownership in a company. When you buy a stock, you are essentially buying a small piece of that company. As the company grows and becomes more profitable, the value of your stock can increase. Think of it like this: if you own a piece of a successful pizza shop, and the shop starts making more money, your piece becomes more valuable. That's essentially how stocks work. You benefit from the company's success. Stocks have the potential for high returns, meaning you could see significant growth in your investment. However, they also come with higher risk. The value of a stock can fluctuate significantly based on market conditions and the company's performance. This means you could potentially lose money if the company doesn't perform well or if the market takes a downturn. It's important to understand this risk before investing in stocks. Diversification, which we'll discuss later, can help mitigate this risk. Next up, bonds. Unlike stocks, which represent ownership, bonds represent loans. When you buy a bond, you are essentially lending money to a company or government. In return, they promise to pay you back with interest over a set period. Think of it like lending money to a friend. They promise to pay you back with interest, and you have a reasonable expectation of getting your money back. Bonds are generally considered less risky than stocks. Bonds are generally more stable than stocks, meaning their value doesn't fluctuate as much. However, this stability comes at a price, typically lower returns. You are less likely to see explosive growth with bonds compared to stocks. Bonds are often used to balance out a portfolio, providing a more stable foundation. They can be a good option for investors who are risk-averse or who are looking for a more predictable income stream. Now let's talk about mutual funds and ETFs, exchange-traded funds. These are investment vehicles that pool money from multiple investors to create a diversified portfolio. Think of it as a basket filled with different types of investments. Instead of buying individual stocks or bonds, you are buying a share of this basket. This allows you to instantly diversify your investments, reducing your overall risk. The biggest benefit of mutual funds and ETFs is instant diversification. By investing in a single fund, you can gain exposure to a wide range of assets. This helps to mitigate risk, as your portfolio isn't overly reliant on the performance of any single investment. Many mutual funds and ETFs are also professionally managed. This means that experienced investment professionals are making decisions about which assets to include in the fund. This can be a valuable benefit for beginners who may not have the time or expertise to manage their own portfolios. Let's move on to key investment metrics. First up is return on investment, ROI. ROI measures the profitability of an investment. It tells you how much money you've made relative to your initial investment. A higher ROI indicates a more profitable investment. It's a crucial metric for evaluating the performance of your investments and comparing different investment opportunities. ROI is calculated as net profit cost of investment x 100. For example, if you invest $1,000 and make a profit of $100, your ROI would be 10%. This means you've earned 10% on your initial investment. Understanding ROI is essential for making informed investment decisions. It helps you assess whether an investment is worth your time and money. Always compare the ROI of different investments before making a decision. Next, let's talk about risk. In the context of investing, risk refers to the possibility of losing money. All investments carry some level of risk, but some are riskier than others. Understanding your own risk tolerance is crucial for choosing the right investments. Are you comfortable with the possibility of losing a significant portion of your investment in exchange for the potential for higher returns? Or are you more risk-averse and prefer more stable, lower-return investments? Volatility refers to the degree of price fluctuation of an investment. A highly volatile investment will experience significant price swings, both up and down. This can be unsettling for some investors. Stocks are generally more volatile than bonds. Understanding the volatility of an investment can help you manage your expectations and avoid making emotional decisions based on short-term price fluctuations. Diversification is a key strategy for mitigating risk. It involves spreading your investments across different asset classes, such as stocks, bonds, and real estate. The goal is to reduce your overall risk by not putting all your eggs in one basket. The primary purpose of diversification is to mitigate risk. By spreading your investments across different asset classes, you reduce your exposure to any single investment. This helps to protect your portfolio from significant losses. Diversification doesn't guarantee profits, but it can significantly reduce your risk. It's a crucial strategy for long-term investment success. The classic analogy for diversification is not putting all your eggs in one basket. If you put all your eggs in one basket and drop it, you lose all your eggs. But if you spread your eggs across multiple baskets, you are less likely to lose them all. This analogy perfectly illustrates the importance of diversification in investing. Don't put all your money into a single investment. Spread it across different asset classes to reduce your risk. Now let's move on to practical advice for beginners. First and foremost, start small. You don't need to invest a lot of money to get started. Begin with manageable amounts that you are comfortable with losing. This allows you to learn the ropes without risking a significant portion of your savings. As you gain experience and confidence, you can gradually increase your investment amounts. Consider investing regularly, even if it's just a small amount each month. This strategy is known as dollar cost averaging. It involves investing a fixed amount of money at regular intervals, regardless of the market price. This can help to smooth out your returns over time and reduce the risk of buying high and selling low. It's a disciplined approach to investing that can be particularly beneficial for beginners. Don't be afraid to seek advice from financial professionals or online resources. There are many qualified financial advisors who can help you develop a personalized investment strategy. There are also numerous online resources, such as websites, blogs, and forums, that can provide valuable information and insights. Just be sure to do your research and choose reputable sources. Before investing in anything, do your research. Thoroughly investigate potential investments to understand their risks and potential rewards. Don't just blindly follow the advice of others. Read company reports, analyze market trends, and consult with financial professionals. The more you know, the better equipped you'll be to make informed investment decisions. Choose investments that align with your financial goals and risk tolerance. What are you trying to achieve with your investments? Are you saving for retirement, a down payment on a house, or something else? How much risk are you comfortable taking? Your investment strategy should be tailored to your specific goals and risk tolerance. There's no one-size-fits-all approach to investing. Before you start investing, set clear and realistic financial goals. What are you hoping to achieve with your investments? Are you saving for retirement, a down payment on a house, or your children's education? Having clear goals will help you stay motivated and focused on your investment journey. It will also help you choose the right investments to achieve your objectives. Finally, remember to monitor and adjust your portfolio regularly. Review your portfolio performance to see how your investments are doing. Are they meeting your expectations? If not, you may need to adjust your strategy. Market conditions change, and your financial goals may evolve over time. It's important to adapt your investment strategy accordingly. Ready to take control of your financial future? Start by opening a brokerage account today. Click the link in the description below to find a list of reputable brokers and resources to help you get started. Don't wait, start investing in your future today. Like this video, subscribe for more financial tips, and share it with someone who needs to demystify investing.